Sergio, I can
Please.
see your water bottle, I think,
Oh, okay. Yeah, that's not good. All right.
but I know it's nice to see you're hydrated.
Sure. Let's figure out how to flip this.
Okay. Hi,
Ah, there it is.
everybody. Okay. Everybody, thank you very much for joining us. We have Otto Energy management meeting, and I guess from my point of view, selfishly, I'm incredibly interested in Otto because of a few things. Number one, a strong management team led, and everyone's on it here, led by Mike Utzler, longtime oil and gas executive. But there are a few things that I think are really interesting is in a market where people are looking for cash flow, when I look at companies like Otto, they really scream at you, cash flow machines, if you will. And not only that, there are other, and I'm sure that the team will talk about it, other acquisition opportunities out there that could be potentially cash flow accretive. But really, to me, as much as anything else, when you find a company out there that has a strong cash flow, repeatable cash flow that you can buy at a very, very cheap multiple, that's always something that's really interesting to me. And with that, maybe Mike, Philip, Sergio, I'll turn it over to you in whatever order or whoever wants to speak first.
Well, thank you, Greg. And, on behalf of the Otto team, both the two of my colleagues who are on the phone tonight and myself, we appreciate this opportunity to talk with those of you who have joined us in your morning and or afternoon. For us, it's late evening in the U.S. We're all three based in the U.S. But what we'd like to do is take just a few moments. We'll walk you through the Otto story for those of you who are not as familiar with Otto as others on the call. And then we'll work to ensure that we leave time for any questions that you might have. But Greg did an outstanding job of actually setting us up with regards to the nature of our intent of what we wanted to try to accomplish this afternoon with you. And that was, I forgive me, as always with these, because there are some forward-looking statements or comments that I may make. This is our full disclosure associated with that aspect. But really, what we want to do is give you a sense of it is an experienced management team, based in the U.S. essentially, albeit Australian listed. And I'll talk briefly about that aspect. To talk a little bit about the nature of our base assets and the underlying strength of those assets that frame the balance sheet and our abilities to deliver the strong financial performance we're delivering. To talk a bit about how we've taken that balance sheet and built an operating model that ensures we protect the balance sheet, but that we also use the balance sheet and its opportunities in the marketplace today with opportunities. To then briefly give you a sense of what we're doing around growing the company while protecting and preserving the flexibility of that balance sheet. And finally, how that should yield ultimately a significantly greater return to those who choose to invest and to participate in the company's growth aspect of that. So those are the 5 key points that we want to stress. Obviously, with a junior oil and gas entity listed on the Australian market, as always in these companies, it does start with management and the credibility of that management and their capabilities to perform. It starts, myself, I joined Otto in September of 2020. I'm actually the newest member of the team. But having said that, I've spent almost 45 years in the oil and gas industry. I'm a petroleum engineer by background. I spent 36 years with Amoco and BP, retired from BP and joined Woodside. Many of you may know me from my Woodside days as chief operating officer from 2013 to 2018. And then at the end of my 5-year contract, came back to the U.S. And have partially retired, but then came out of retirement to join the Otto team as I mentioned, in September. Sergio, who's on the telephone today, is our chief financial officer, and he'll have a chance to talk as we go through. Julie Dunmore is located in Australia. She's our chief controller, based out of Perth. Phil Trajanovic, who is on the call also, is our senior commercial manager and land manager. And then Will Armstrong is head of our BP as VP of Exploration and New Business Opportunities and Development. This team itself has 150 years of experience, and combine that with the 4 key technical, of which Will is a part of that, brings over another 100 years of experience. Much of that in the Gulf of Mexico, onshore and offshore, but equally around the world and in different parts of the oil and gas and energy sector. Myself, I've had significant experience both upstream, midstream, and downstream from an energy developments perspective. And each of us brings our own unique set of skills. It's a very strong and capable team with vast knowledge of the Gulf of Mexico, as I mentioned, onshore and offshore. Excellent connectivity and working relationships, both in a commercial and financial sense, as well as in a technical sense, which has proven to be invaluable as we've moved to developing our position as a preferred partner. We are a non-operating company at this point in time. We have the capacity to operate, but we have chosen to take a non-operated working interest position, both onshore and offshore Gulf of Mexico, to allow us to build our platform and our portfolio as we've outlined. And I'll touch base on that in a moment. The company's 4.8 billion shares in the marketplace. We're trading at 1.5 cents a share as of yesterday. And as you can see, we've got a market capitalization of about 72 million. We've been as high as 1.9 cents 2 to 3 weeks ago. We've had a small drop back as oil has kind of adjusted itself up and down, but we've been a very strong performer over the last 6 months in the market in particular, and I'll show you a view of that strength in just a moment. I think importantly to the comments that Greg mentioned, we've gone from as all energy companies went through a very difficult period as in beginning of 2020 with the downturn in oil and gas prices, and obviously COVID's impact on the market in terms of supply and demand. We truly struggled, and we hit a low of 0.006 tenths of a cent in early 2020. And since then, we've rebounded to nearly triple that in the marketplace. But we've also gone from a position of minimal cash balance to a very strong balance sheet today of over $26 million in the bank. We've got a debt facility that as of January 1st, we had remaining $6.9 million to pay down on that. I would say here, we're getting ready to release our quarterly. It's no secret with regards to the aspect of that particular entity, in that we have a facility with Macquarie that we drew on heavily in early 2020 to facilitate our abilities to fund our portfolio of assets. We've been paying that back on a quarter by quarter basis, and we did make most recently another $2.3 million payment, which brings our overall debt down to below 5 million, 4.6 million in its totality. So we got $26 to $30 million in the bank. We've got $4.6 million in debt, and we own 3.272 million shares of Pantheon, which is traded on the London Exchange. And as of today, its market value, unrestricted from our perspective of being able to trade, is an incremental $6.3 million US that would be represented. So I think when you look at our, value proposition one is it should jump off the page to all of you that we set with a market cap of $72 million Australian, and we have either in the bank or available to be in the bank nearly $50 million Australian cash. Yeah. Which gives you a sense of the strength of the company and where we sit today. Our registry has become much more active in the second half of 2021 and 2022, with an average trading volume of 6 to 10 million shares a day, which is significantly improved off of what we saw in 2020, which was substantially minimal movement. I put this up just for a second because we're obviously quite proud of the fact that we are slowly but surely being recognized in the marketplace for the value that we represent as a junior oil and gas. And this is some of our competitors across Australia from a marketplace standpoint. And you can see that we are the blue. as OEL, and you can see how we've performed, particularly since October of last year relative to our peer group of Australian entities. And yet, having said that, and obviously proud of the performance that we've seen in terms of improvement of share price recognition, we still are significantly undervalued in the marketplace relative to our balance sheet on any metric that you would choose to evaluate us on the basis of multiples on production, multiples on 1P reserves, 2P reserves, our EBITDA, our EBITDAX, each of our EV value valuation process would give you a sense that we are significantly still undervalued and therefore represent good value in terms of considering us to be included on your registry or purchasing our shares to, off of our registry. I won't belabor this. It's obvious. We all know that while this is slightly dated, it came from IHS. It basically reflects what we've all now seen is that, a tremendous increase in oil prices, gas prices. Gas in the US on the Henry Hub is trading at $6.30 plus an MCF, which is just, incredible, to be quite honest. At this time of the year in mid-April, to see $6 gas in the US is just quite remarkable. And when you consider that 40% of our production is gas, we're benefiting from obviously high prices in the gas market and obviously $100 oil in the oil market side of the equation. The company went through a significant amount of essentially rebasing itself during the downturn due to COVID and due to low oil prices, like every company did. And so probably in that regard, very little difference between ourselves and others. We did take that opportunity to substantially reshape the company from the ground floor up. We reduced the size of our board. We reduced the size of the organization. We cut more than 40% of the costs out of our organization from an overhead standpoint. We worked with our operators to reduce by almost 40% the operating costs. And we've moved to a place where our break-even cost for all in, both from a G&A standpoint or overhead standpoint and direct operating cost, is approximately $10 a barrel of oil. Against a $100 oil world, our cost to be in business as Otto is $10. That does not include, obviously, investments associated with the pursuit of developing new barrels, new reserves for our balance sheet, but $10 for our existing production operations and continuing efforts to grow the company. But we did, in fact, as I've already described, strengthen the balance sheet substantially. We introduced and developed a differing operating model and a fiscal model that I'll touch base on to give you a sense of how we measure or how we test every opportunity to invest to try to ensure that we maintain a strong balance sheet going forward. We've overhauled the company top to bottom line. But we're in a position now where the market's rebounding, oil and gas prices are high and strong, and every company that's used the last 2 years leading up to this point to build inventory are looking for ways to stretch their dollars, to maximize the opportunities to build and to drill their inventory of prospects in the Gulf of Mexico, both onshore and offshore. We've looked at over 100 prospects over the last almost 12 months now, targeting at this point those which met from our initial screening, the opportunities to recommend to our board to invest 4 differing projects, of which we've actually captured 2 of those projects and are in contention for a third. We're not successful on the 4th. So we've been very disciplined is the message that I really want to leave you with. But our focus for growing the company now in 2022 and 2023 in particular is to focus on 3 key areas. 1, to look at PDP acquisitions. There have been a number of companies that are distressed, who are opportunities rich and cash poor, who are looking for ways to raise capital, and there's good assets to be bought, both in a company sense, in an individual asset sense, and certainly then in the second aspect of our focus, it's to look at participating in a non-working interest, or excuse me, in a non-operated interest basis in the drilling of 4 to 6 wells targeted this year to be drilled off of our balance sheet. and to continue to then invest in the existing 3 fields that we already have an interest in. And I'll touch base briefly on those. The benefit over the next 2 years is proving to the market that we can maintain that discipline in our balance sheet, that we can continue to grow our balance sheet through the strong cash flow performance from our existing fields, and that we can successfully identify and capture new opportunities to replace our reserves and actually grow the company on a resource to reserves to production basis year on year. Over these next 2 years gives us the opportunity, we think, to then look at more significant means by which we can leverage our scale to grow the company with an intent to look at how we double the company every 2 to 3 years in size and size. The 3 assets that we have: South Marsh Island 71, non-operator, but 50% working interest in that asset. South Marsh Island 71 is significant. It was the first Gulf of Mexico property that Otto bought into with regards to its existing base. And Byron is the operator on the other side, a well-known Australian junior oil and gas as well. That field is one of the 10 largest discoveries in offshore shelf Gulf of Mexico in the last decade. And it continues to, in fact, interesting note on this is that the 2 of the 3 wells that are producing with our interest on behalf of are the number 1 and number 3 largest oil producing wells in the Gulf of Mexico shelf, excluding deep water. So a very significant, very prolific asset for us, and has been it is oil with associated gas, significant contributor to our bottom line performance on a month-by-month basis in building cash flow. Lightning was part of a multi 8-well opportunity, which ultimately we drilled 5 wells with Hillcorp on a greenfield exploration basis, and discovered onshore Matagorda County one of the 10 largest gas fields in Texas in the last decade, which is called the Lightning Field. We have 2 wells producing there, and they have been very, very strong performers and producers. And there's upside, as we'll touch on in a moment, with regards to additional drilling opportunities to develop existing resources and reserves. And then finally, our 3rd field, GC21, was a subsea deep water tieback to an offshore structure. That well did not perform as expected in its initial completion, and we are waiting with the operator to essentially recomplete that well to the main reservoir within the well, which holds 70% of the well's original expectations. And that workover recompletion is expected to occur in late August, early September. The rig is under contract. It's performing work for another operator on 3 wells. And then as soon as it's completed, Talos will take control of the rig and begin that work. And as I mentioned, we expect that work to occur in late August, early September. So those are the 3 core assets. I've just got a couple more points to make, and then we'll turn it over to questions. Sure. As a result, we've got producing from the existing wellbores that you see in those 3 fields, access to 4.1 million barrels net of barrel of oil equivalents reserves associated with that. Within those 3 fields, we have an additional 2.5 plus or 2.3 plus or minus million barrels of oil equivalents of reserves to be developed. So within our own backyard, in these existing fields, through drilling additional wells or recompletions, we can add an additional 2.3 million barrels. And then depending upon overall performance of the fields against long-term recovery, there could be as much as another 2 million barrels in those 3 wells or those 3 fields alone expected to be delivered. We expect to spend somewhere between $15 and $20 million net over the next 2 years to fully develop those resources and reserves within those fields. And that's fully accounted for in our ongoing budget and communications to market. I mentioned several times our operating model and the importance of the discipline that we have brought to the company in terms of trying to focus on how we grow value for our shareholders. And it really comes down to this. We are no longer looking at greenfield exploration. We look at lower risk opportunities to develop with some upside that's driven by existing infrastructure. Being in a place where you don't have to pay for platforms and pipelines, but on a minimal basis in order to connect to the marketplace. We continue to prioritize on conventional oil and gas. We do not play in the unconventionals. That's we're too small a company, and that's too demanding on a constancy of cash flow to justify us participating in the unconventional side of the U.S. opportunities. We're targeting, obviously, the benefits of being in the Gulf of Mexico. The Gulf of Mexico is the lowest carbon intensity basin in the world from an oil and gas producing standpoint. And so it's a good place relative to those concerns that are expressed around ESG for us to focus on in terms of developing replacement hydrocarbon potentials for the existing declines that the world is having to deal with against supply versus demand. And finally, it's a very mature basin with tremendous infrastructure that allows us tremendous flexibility at the same time to bring our product to market, oil or gas, to multiple oil markets, multiple gas markets. And we actually see a premium for both our oil and our gas, typically as a result of that flexibility that we can attract. So Henry Hub Plus and WTI Plus are usually the positions that we're able to secure from a marketing position. Bottom line is we're looking for portfolio free cash break even at $15 to $20 a barrel of oil. And that includes our forward investments on a year-on-year basis for developing new resource potentials, to maintain a gearing ratio no greater than 50% during our growth, and through our existing assets, a gearing ratio of 20 to 30% required to manage. So essentially managing off of our balance sheet and a small debt facility that we would look to continue to keep in place to leverage prudently our maintenance of our balance sheet as we look at new opportunities, to keep our debt to equity ratio below 50% and to look for high rates of returns on a DROI 15 or greater basis and a ROCE greater than 15% basis. That allows us to ensure that we continue to balance the amount of funds that we're investing to grow with the opportunities to look at how we return value to the shareholders as appropriate in the form of distributions and some combination therein. At this stage, largely looking at growth through the continued investment, but at the same point in time, realizing that shareholders want to have line of sight to where the return is to them, not only in share price, which we think as we've demonstrated, significantly undervalued, but equally in terms of what we believe we will ultimately be able to provide back to our shareholders as a result of our successes. And I'll really stop there. It's to give you an idea that we've got a lot of activity in front of us, but that activity can be managed from our balance sheet and from a small scale debt facility. We are not looking at raising equity unless there's a company making opportunity to buy or to merge the company in creating scale. What we do recognize is the importance of trying to grow the company over the next 3 to 5 years in this super cycle of high prices in a manner which allows us to build genuine scale of company so that as we move forward, we have greater portfolio opportunities to enhance the value. And with that, I'll kind of stop. I know that was a whirlwind, but it hopefully gives you a very good idea of the fact that we've got 3 principal areas of focus, and that is drilling individual wells, looking at existing production acquisitions with upside, and managing our balance sheet to ensure that we can be ready for both those opportunities as well as right-sized acquisitions for a company of our size.
Right. Mike, or for any of you, I suppose, one of the questions I'm getting, and I have as well, is when you say scaling up the business, like economies of scale, what would they be? Can you be a little bit more specific? What would they be as opposed to just finding a really good project out there and just buying it?
So I think you kind of answered that. That's a good question, Greg. And I think you answered it in part by the way you posed the question. I think what we see is that there are operators of all sizes, from large to very small independents, who have developed over this last 2 years the building of their portfolios of opportunities. And in the smaller cases, it may be 1, 2, or 3 or 4 wells that they've had the opportunity within their area of control to identify and develop. For larger companies, the Taloses, the Hill Corps, they've got a much larger portfolio, and they've been high grading that portfolio. So they're looking at either programs of wells, which may be 4 or 5 or 6 wells within a given field to be developed, and they're looking to stretch their dollars. One of the things that, of course, continues to be a reality for the oil and gas industry is it's capitally constrained, and it remains capitally constrained. And so companies are rich with prospectivity, but challenged by having the cash position to be able to fully fund on their own accord those opportunities. And so they're looking for partners to be able to bring in and shed some of that to stretch their dollars to getting more wells drilled. Everyone's looking to try to drill as many wells as possible in the next 2 to 3 years, given the expectations of continuing high prices over this super cycle of 3 to 5 years. And so we're looking at it through the lens of, we don't want to just take one-off opportunities all across the Gulf. We're looking for and have concentrated in 16 core areas, onshore and offshore, around salt domes or play concepts that we have confidence technically and commercially will work. And then looking at who's in those areas and what types of opportunity sets they're proposing in the marketplace, both proactively seeking out and reactively responding to parties who come to our doors to express an interest in looking to partner. And so we're trying to balance between individual wells that are targeted within a core area, all the way up to fields and assets. And in some cases, we've looked at 4 differing smaller companies for acquisition of their assets in entirety.
Right. Okay. This next question, maybe it's for Sergio, but I'm not sure. Someone is asking, the cash position of 26 million, is any of the cash restricted as a, part of the debt covenants?
Sergio, you're muted.
Yeah, I can't hear you, Sergio.
Yeah, sorry about that.
Yeah.
No, that's a good question, Greg. That is correct. $5 million of that is restricted.
Okay.
That's held in escrow that goes towards our debt facility. But as we march towards the termination of that facility in November, that 5 million will slowly shrink as our outstanding balance is. So as Mike mentioned, now that we have $4.6 million outstanding, only 4.6 million of that is restricted, and that'll shrink as our debt balance shrinks.
Right, sure. Right, last time I checked, they can't restrict you on more than the actual outstanding.
Exactly.
So, okay, and that's, as you said, that's rolling in November, and I assume that current energy prices are much higher than the hedges you'd have in place right now.
Yeah, so we're not actually required to have any hedges post-November when our facility expires. But obviously, as a management team, we meet with the board regularly. We look at it, we look at prices, we look at quotes, and we'll decide as a team whether to lay on any additional hedges. But absolutely, the latest quotes we have are, fourth quarter is well over $90, and calendar 23 is well into the high 80s, which is at a much higher premium than our current $56, $57 base hedge position, which were put on back in 2019 when we first entered into the facility.
Right. And as Mike, you alluded to earlier, your cost per barrel, like on what's in the ground right now, is $10 per barrel.
Yes.
Okay. So there's obviously a huge margin.
And again, to emphasize, that's split literally almost in half between the cost of us as a company doing business, being a publicly listed company, and paying for our 6 employees plus 3 board members, plus the actual operating costs of those assets that we pay the bills, our portion of the bills on for the production of those barrels and those molecules of gas. Okay, great. The next question, I'm just getting it from a WhatsApp. Just someone's asking me about at Green Canyon, and it's for any of you. You said it's going to be worked over towards the back half of the year. Is there any preliminary look at how much it could be improved operationally? So, estimates at this point for expectations is approximately 2,000 barrels of oil a day. that is 8/8, and we own 16% of that. So we would be looking at about plus or minus 300 barrels of oil
Okay, it's not.
per day, plus associated gas.
Okay. Okay. And I don't know. I'll ask the question that someone's asking is, are you more sensitive to oil prices or gas prices? I don't know how you'd really answer that, but I'm putting it out there.
In the short term, we're more sensitive. We're fully unhedged on gas. So we've, as I mentioned, when you look at our split on a volumes basis, correct me, Sergio, it's 40% gas, 60% oil.
Yes, sir.
And on a net income basis, it's slightly different, based upon gas versus oil in terms of pricing. But because of the fact that we are hedged, about 60% of our oil production is actually hedged under the current agreement. Macquarie's been, quite reasonable in terms of as we get to the late stages of this debt facility, and the realities of highly volatile but ever increasing oil price over the past 6 months. We've been able to reduce from what was 80% hedged in 2021 to 60% of our volume hedged in 2022. And as Sergio said, that expires in September. So in the short term, we're more sensitive to high oil prices simply because we don't get to fully realize again on every barrel of oil that we produce the full reality of that oil price.
Got it.
Having said that, we're generating $2.5 to $3 million a month net free cash as a result of our current production stream, only to be enhanced as we get to a place where we're no longer hedged in the back end of this year.
Okay, so just to confirm, that's $2.5 million a month of free cash flow.
Yes.
So it's so it's like $30 million I mean, obviously we're using these numbers, but that would be like a $30 million run rate against an $80 million market cap. Incredible. Guys, and I know you see, and I've spoken to you about this offline. You see, and then Mike, you spoke about acquisition opportunities. You've got the big cash balance sheet, number one. Number two, you're obviously generating more cash. Do you see, you said that, there are a few opportunities out there that are meeting your hurdles. Do you anticipate seeing more or less of those over like the next 6 to 9 months?
I think we actually expect to see more. During the realities of the downturn of 2020, I think from an industry standpoint, you saw a huge spread between bid ask on M&A activity, and therefore very little M&A activity other than that which was out of necessity. As a result of higher prices, ironically, you've seen a narrowing of the bid ask price on mergers. And certainly, the merger focus has been predominantly onshore unconventionals in the US, massive, activity set over the last year and continuing, quite honestly, in the continuing consolidation. That's starting to spill over though in the conventional side of oil and gas. In the Gulf, in particular, offshore and onshore. And so we're starting to see increasing activities. We're starting to see what is people realizing from an inventory standpoint, helped ironically in some parts by the fact that the federal government has, indicated a further year's restriction in probability of federal lease sales. So no federal lease sales in 2022 or 2023 from an offshore standpoint. So people are looking for inventory and for growth. And that growth is going to come not from being able to buy new leases in the marketplace, but looking at existing companies and existing leases.
Right. Got it. Okay, everyone, just conscious of the time, and also especially that it's pretty late over there in Houston. If anyone else has any more questions, or if you think about something after the fact, please reach out to us, and we'll be sure to relay it to the team, or you can ask the team directly. Guys, thank you so much for your time. Again, for everyone, if you're looking for a really compelling, repeatable cash flow story with upside, I think that Otto is definitely worth the look.
Greg, thank you to the 180 team for giving us this opportunity to talk to your clients.
Great. Thanks, Mike. Thanks, everybody.
All right. Thank you, everyone.
Bye-bye.
Thank you.
Cheers.
Thank you for watching another presentation by 180 Markets. Don't forget, if you want access to thousands of ASX capital raises, head on over to 180markets.com.au, sign up, and get on board for our very next capital raise. Thanks for watching.